Hello class, this is a video recording of chapter 14 of the personal finance text, and the title of the chapter is The Practice of Investment. The practice of investment. Once you have developed your investment policy statement and have determined your goals, risk tolerance, and constraints, it is time to choose a strategy and to act. Learning objectives. Explain how leading economic indicators are used to gauge the current economic cycle and the outlook for the economy. Explain how indexes are used to gauge financial market activity and as benchmarks for asset classes and industries. Identify and evaluate sources of information used to analyze and forecast corporate performance. Sample and evaluate media outlets providing investment information and advice. Investment information. Asset allocation. When it comes to asset allocation, it subdivides into the economy and to the market, where you can allocate your assets to. And then you also have to consider security selection and the industry and the company as well. When it comes to asset allocation via the economy, you have a couple of things to consider. One of them is GDP, or gross domestic product, inflation, which further subdivides into the currency valuation as well. The unemployment rate also has an important factor when it comes to asset allocation. The unemployment rate is mostly important because unemployment is directly connected to many other social issues that can take place in a country. So, like for example, if you're trying to invest in a country that has a relatively low unemployment rate, you can almost be certain that there are less, less instances of um, theft and things like that. When there's high unemployment, people are more willing to commit crimes and things of that nature. And actually, as part of the theoretical framework that I developed in my dissertation, supports that theory. And if you're interested to read some of the statistics that I found in the relationship between unemployment and willingness to commit crime, you can let me know, or you can just Google my dissertation by typing in Carl Letamendi consumer sentiment, and then you should be able to find my dissertation. And then we also have the index of leading indicators. And then leading indicators are things such as GDP or CPI, which is the Consumer Price Index. And there's all sorts of indices that are produced by either universities or think tanks, which help to measure how the economy is doing. And some of them are more recognized than others, like the Index of Consumer Sentiment, which is produced by the University of Michigan Survey Research Center. And then the Conference Board Consumer Confidence Index is another one. And all of these are looked at, and when these indexes are produced, usually the market reacts to this news. Investment information. The index of leading economic indicators published monthly includes the length of the average work week in hours, initial weekly claims for unemployment compensation, new orders placed with manufacturers, the percentage of companies receiving slower deliveries from suppliers or vendor performance, contracts and orders for new plants and equipment, permits for new housing starts, the interest rate spread or the difference between the 10-year Treasury bond and the Federal Reserve fund rate, the overnight rate that banks use to lend to each other, um, the index of consumer expectations, which again, University of Michigan index, and this is called the ICE, and then there's also the ICC, with the Index of Consumer Confidence, or the Index of Consumer Sentiment, the ICS, and all of these are produced by University of Michigan, SRC, Survey Research Center. The change in the value of the index of stock prices for 500 common stocks, and the change in money supply. The change in money supply is the money that's in circulation in the country. Asset allocation. Now we're going to talk about the market and index performance. Security selection, industry and company, and then you have, when you're looking at an annual report of a company, you're looking at their 10K. That's their, if you go, like if you Google, for example, Apple 10K, you'll find their annual report, and then you'll also find published analysis of the companies and the industries that you want to look into. Investment information, online credibility. Here we have some questions and some protocols. Can the content be corroborated? Check for some facts. Is the site recommended by content expert? Look for ratings or recommendations. Is the author reputable? Check the author's name. Do you see the site as accurate? Check with other sources. Was the information reviewed by peers or editors? Read the reviews or the logs. Is the author associated with a reputable organization? Check the organization. Is the publisher reputable? Check the publisher's name. So one thing, I'm gonna take a really small break right now, because whenever you see news, for example, produced about the state of the economy or something like that, you have to realize that in the field of journalism, they're not exactly experts in the realm of finance and investments. So a lot of times these journalists get news from other sources, more credible sources like AP or Reuters news and like the major news networks, and then they tweak it and then they present it to their consumers, or they pick out which news they feel their news consumers would prefer to hear. So if you see anything about like the ups and downs of the market, or any inferences that are made on why the market's up, why the market's down, it would be a really good idea to cross-check with other reputable sources as well. So some of them, off the top of my head, you can check with Bloomberg, which is a good one. Any news that comes directly from Nasdaq or the New York Stock Exchange, the Chicago Mercantile Exchange, or the CME are also pretty good ones to look into. Um, New York Times, if I haven't mentioned that already, and also Morningstar. Morningstar is a pretty good one as well. Are the authors and sources identified? Look for source citations or references. Do you see the site as current? Check the last updated headline or date. Do other websites link to this one? Look for links. Is the site recommended by a generalist? Ask a librarian. Is the site recommended by an independent subject area? See site referrals. Does the domain include a trademark name? Look for a trademark in the URL. Is the site's bias clear? Check for a statement of purpose. Does the site have a professional look? Look for a clean design and error-free writing. And these are all very important things, because when you're trying to consider what to invest in or how to invest in something, you want to make sure that the source where you're getting information is accurate, it's clean, and it's and it's up to date. Key takeaways. Useful investment information analyzes the current economic, industry, and company performance. Leading economic indicators are used to gauge the current economic cycle and the outlook for the economy. Indexes are used to gauge financial market activity as benchmarks for asset classes and industries. Analysis and forecasting of company performance is based on publicly reported information from the SEC or the Securities Exchange Commission filings and from corporate annual reports. Many media provide investment information and advice for both experienced and novice individual investors, and such advice is readily available online. The key to finding useful information is in understanding the credibility and reliability of its source. Learning objectives for investing and trading. Identify the important differences between types of investment agents. Describe the different levels of service offered by investment agents, and that's going to be very important, because you don't want to go to the wrong person for the wrong thing. Analyze the different fee and account structures available to investors, and differentiate the types of trading orders and explain their roles in an investment strategy. So when it comes to agents, you have brokers, you have dealers, and then you have broker-dealers. And we have different services that are provided, different fee structures. You have different account types, and then you have orders. So then under services, you have discretionary trading, you have advising, and then execution only, which are different types of services that are provided. An investment advisor, sometimes commonly referred to as a RIA, is going to be somebody who kind of acts like a coach and guides your investment strategy. Execution only, you just give the money to the firm and then they manage it for you. This is kind of like what happens when you have a 401k account and that money is split up into various mutual funds. You just give it up and they manage that for you. Different fee structures. You have commission based. So this is like the most competitive one, maybe a little bit higher risk because when it's commission based, they want to make sure that they maximize your investment, and in order to do that, they have to invest in higher yield investments, which are usually higher risk. There's some that are also a fee base, and some of them are also a flat fee. You might find a little bit more along the line of a flat fee when it comes to advising, and sometimes maybe execution only as well. If you have, for example, Bank of America's Merrill Lynch Edge platform or ING Direct, sometimes they'll charge you a flat fee for putting in an order, and then they'll just execute the order for you. Accounts, you can have cash accounts, margin accounts, which is kind of like getting a loan for an investment, and this is more like trading on the stock market. And then you can also have custodial accounts, and then orders, you can have a market order, you can have a limit order, stop loss, and stop buy orders, and these three are actually um, ways to set up margins to prevent losses. So like for example, if we have like let's say a stock market, let's pretend that this is just a stock market in, I don't know, in Broward College stock, right? Or whatever. So then let's say that it's going to go up and down and up and down and up and down like this. And then we're right here at this point in time and we're not really sure where the stock is going to go. But you have noticed that the stock has gotten at least this high and at least this low. So you want to try to minimize your losses. So you can set a limit to prevent your losses, and then you can set up another limit to actually execute that buy order. So then what that means is that if the stock, for example, gets to this point, which is a low point, you end up buying at this point because you expect that this is probably as low as the stock is going to go. And then once you buy it, you're hoping that the stock will go up here at maximum, and then this is when you'll automatically execute a sell um, order. So then you what you make is the difference between this area and this area right here. So that's your earnings right there. A little bit more along the lines when it comes to day trading, but this is like the idea. So to give you a visual of what these limits could be. And it does get a little bit more intricate, but since this is Fin 1100 and not like a stock strategy class, we're gonna leave it at that for now. But if you have any questions about anything you're curious about, you can always feel free to outreach to me, and as always, I'll be more than happy to talk to you about it. Key takeaways: a broker trades on behalf of clients, a dealer trades for its own account, and a broker dealer does both. Okay, so a broker deals on behalf of clients, which is you. A dealer trades for its own account, and then a broker dealer does both. So then you can kind of get an image of who services who. Brokers, dealers, and broker dealers may be independent firms or subsidiaries of investment banks, just like Merrill Lynch's Edge or ING, commercial banks or investment companies. Firms may offer several levels of brokerage services, defining their roles as active manager, advisor, and or traders. Discretionary trading, advisory dealing, or execution only. Brokerage fees are based on the level of service provided and may consist of commission on trading, advisory fees based on portfolio value, or a flat fee for management. Brokerage accounts may be cash accounts, margin accounts, or custodial accounts, and trading orders allow you to better execute a specific trading strategy via market orders, limit orders, stop loss orders, or stop buy orders, which I covered in the visual with the Broward College stock that I showed you. Ethics and regulation, learning objectives. Discuss the reasons that investing behavior may be unethical. Identify key professional responsibilities of investment agents. Describe practices that investment agents should pursue or avoid to fulfill their professional responsibilities. Explain how investment agents are regulated, and debate the role of government oversight in the securities industry. Market vulnerabilities. Investing is a complex, volatile, and unpredictable process, such that the complexity of the process lowers the probability of getting caught. The stakes are high enough and the probability of getting caught is low enough so that the benefits can easily seem to outweigh the costs. The benefits can even blind participants to the cost of getting caught. The complexity of the situation may allow some initial success, and the unethical investor or broker becomes overconfident, encouraging more unethical behavior. Employers may put their employees under pressure to act in the company's interest rather than clients' interest. So this kind of happened. Yeah, unethical behavior, for example, when it came to, if you look up the case of Bernie Madoff, for example. So what Bernie Madoff did is he had a little printer from way back in the day, and he used to work with a government regulating agency. So he was trusted, and he opened his investment firm, and he would collect deposits from people and show and produce fictitious statements until he was caught. So that's an example of unethical behavior because he wasn't supposed to do that. We have regulatory agencies nowadays that try to provide a little bit of oversight and laws of what constitutes ethical and unethical behavior when it comes to investing. So some of the ones are the Securities Exchange Commission, which tries to regulate that. And then you also have under the Securities Exchange Commission, FINRA. And I actually had an opportunity to work with FINRA a little bit. And basically what they do is that whenever there is a dispute between an investment firm or broker and an investor, then the courts authorize FINRA to handle the dispute and to either make a judgment on what the outcome of that dispute should be or to mediate to try to find middle ground. So ethics and regulation. Here we have unethical behavior and ethical behavior. You have complexity, high stakes, competition, and feedback, which all kind of provide grounds to facilitate the unethical behavior. And then you also have market forces, professional standards, and legal restrictions um, that facilitate ethical behavior. And then there's one I think that's missing, and that's also licensing. And licensing also helps because when you specialize in one particular area of investment banking or investments in general, you kind of understand the industry inside and out. So whether you're a bonds dealer or you work with futures contracts or stock options, commodities or whatever, you specialize in that one area, you know the industry, and you know what is expected of you. Because just to say, oh, I want to work in finance, that's extremely, extremely broad. That's kind of like saying, oh, I want to get a job in the planet Earth because finance subdivides into so many different things and you can have so many different careers focused into finance that that it's very complex. You can be an investment banker in finance, or if you're a computer person, you can be a computer programmer for a financial industry firm. If you're a mathematician, for example, you can also work in finance helping to develop formulas, to program computers. So there's a lot of different things when it comes to finance. But like I said, the licensing really does help, I think, to facilitate and to promote ethical behavior. Brokers should be loyal to clients, employers, and markets and the profession. Now, there's one thing that I want you to keep in mind. This statement here, brokers should be. Okay? So the should be implies the ethics, right? They technically should be loyal to their clients, to their employments, and to the markets and to the profession. But essentially, there's one objective when it comes to finance, and this is why it's so hard to regulate, and it's this, right? When there's extreme competition, when there's a whole lot of money to be made, when there's a whole lot of networking that you can do, when there's a whole lot of information that you have to research and a bunch of stuff, you essentially want to be able to reap the rewards, right? So when it comes to the realm of finance, and if you insert that element of competition, this is the objective. So then this is the reason why it's so hard to insert ethics into the realm of finance, because you have money to be made, and if you have if inserting ethics means that you're gonna see less of this, then it becomes more tempting to not consider ethics. So there kind of has to be a way to balance it out, where there are limits, and the ethics and what is legal kind of like have a talk with one another, because what a broker should be doing, um, I guess, should be what a broker is legally responsible for doing. And since our financial spectrum is evolving constantly and it's very fast paced, it's kind of hard to pinpoint what that what the ethics should be and what the legal requirements should be. A broker should be loyal to clients, trade for clients ahead of firm, choose investments appropriate for the client, and if they don't, then they mediate with FINRA, like I mentioned. They have to run it by them. Reveal sources of data and analysis, explain without pressure, and communicate often, and then no guru. Have that no guru mentality. Unfortunately, in the South Florida area, we've been plagued by many people who allege that you can get quick returns, you can fix and flip properties and triple your income and blah blah blah. There is no guru when it comes to this. Okay, if you think of everyone kind of like novice to advanced novice, then you should be able to respect brokers and finance people in a different light, because if there's someone who knows a secret to becoming a millionaire, for example, why would that person dedicate their time teaching other people to become millionaires too, instead of also becoming a millionaire and just continuing on with the secret? So I mean, if you think of it this way, if you could tell the future, and if you could tell the future one time, just to give you some perspective, if you can tell the future one time and you knew what today's lotto's numbers were going to be and the jackpot was hundreds of millions of dollars, would you give those numbers to someone else? No. So then the same applies here, that there is no guru, and no broker should imply that they're a guru. Okay. The most that you can do is probably check their credentials and make sure that they have a track record and that they know what they're talking about. Ethics and regulation. A broker should be loyal to the employer, no kickbacks. A broker should be loyal to markets and to the profession, which means no insider trading and no price manipulation. So, insider trading is when you have an unfair advantage because of the information that you have, and price manipulation is when you purposefully manipulate the market to affect the price of something. So, for example, let's say that you have a friend that works for a pharmaceutical company, and this pharmaceutical company just developed a cure for cancer, but you don't, but no one knows that, but your friend knows that. So basically, if you come in and you start buying a bunch of stocks because you know this information now, then that's considered unethical, because you have information that gives you an unfair advantage over the rest. But then when you think about it, since that is considered unethical, but to the person who has that information, it's not, because they have developed a relationship with this person that has yielded valuable. So then how do you differentiate between what's considered insider trading and what's considered a strategy? It's very hard for the person who's on that side of the line. And then price manipulation is like let's say for example that the same company, a pharmaceutical industry, has like a CEO, for example, and you do something or information that can sabotage that CEO's um, image, for instance, right? So I guess one of the things you can do, just kind of like a side project, is if you remember Steve Jobs when he came out with the news that he had pancreatic cancer, I want you to see what the stock looked like the weeks leading up to the news and the weeks after the news, and then see if you can kind of like predict if there was a relationship between the news of his illness and the stock price. And you'll probably find that maybe there was. And the reason is because the markets react to news. So if you, on that same note, if you have information that you can use to manipulate the market, that's also something that you should not do. You should not manipulate the market. Ethics and regulation. Here we have the federal, which is, for example, the Securities Exchange Commission. Then you have some regulators at the state level, and then for example, off the top of my head, um, okay, let's say for Florida, we have the FREC, right? And FREC stands for the Florida Real Estate Commission. Okay, so that's one example. And then we have SRO, and SRO means self-regulating organization. And an example of a self-regulating organization is FINRA, because FINRA regulates itself, and they're a subset of the SEC, but they don't really operate like a government agency. They kind of operate more like a nonprofit, from my experience with FINRA. Okay, so then here we have ethics and regulation, federal oversight agencies. So we have some coordinators who facilitate that. Bank regulators, they protect financial institution. So the FRB, the Federal Reserve Bank, the OCC, the FDIC. I gotta look into what OCC is. I don't remember. There's so many acronyms. FDIC is the Federal Depositors Insurance Company. Um, so like for example, when you look at a commercial of a bank, Bank of America, Wells Fargo, or whatever, they're like FDIC insured. So basically that means that the bank has an insurance that protects you in case like there's like a super hacker that hacks all the computers in the world and everyone's bank account goes to zero. So then the government insures your deposits up to a certain amount. I think it's $150,000. Maybe. I don't know. The NCUA. Then you also have investment regulators that protect the financial markets. So like the SEC is one of them, the Securities Exchange Commission, and then CFTC. And then you have consumer regulation, which is to protect financial consumers. So the FHFA, I think that's federal housing, and then the CFPB, which is the Consumer Financial Protection Bureau. So this is actually a newer one that was created not that long ago. And I remember in my days in DC that I heard of them, um, you know, starting up and stuff. So if you're interested, they are hiring. So they're still in the process of developing, like a full staff and stuff. So if you're interested in this, you can also let me know, and I will send you information if you have time to do a paid internship in Washington, D.C. I can walk you through the process and I'll help you out. So basically, you have people who coordinate and facilitate three different areas. You have you have organizations that protect the institution. You have people who facilitate the protection of the financial markets, and then you have people who protect the consumers. Ethics and regulation, key takeaways. Investing behavior may be unethical because its complexity lowers the probability of getting caught. The stakes are high. And then I'm actually reading the current report of the financial collapse of 2008 because it was part of my dissertation to have that information, part of my research. And One of the things that was very hard to explain is was something called collateralized debt obligations, or CDOs, and CMOs, which is collateralized mortgage obligations. So basically, this is the practice of insurance companies, in part, using what's called derivatives, or like, complex algorithms, to bet on who's going to pay their mortgages and who are not. And even though this happens at a level that we don't see as consumers, it has a direct impact. If you have a mortgage that's either fixed, right? Well, if you're a homeowner in general, but in the fixed versus adjustable rate mortgages, for example, the people who are at the adjustable rate mortgage side are the ones that got the short end of the stick when this caught up. So if you're interested, you can also Google CDO, collateralized debt obligation, and the collateralized mortgage obligation, fixed versus adjustable rate mortgages, and then see how that caused a massive foreclosure, particularly in the state of Ohio, but also a lot happened in Palm Beach County and Broward County, which is also highlighted in the book, in the commission's report of the financial crisis. The stakes are high. The initial success may encourage more unethical behavior, and companies may expect their interests have priority. So you see, initial success may encourage more unethical behavior. So let's say that we're at the Hard Rock, right? And you're putting in money in, and I'm pretty sure maybe you're laughing because you've done this at the slot machine, but you put in 20 bucks, you play the slot machine, and then you go down to 15, and then all of a sudden you hit, a certain combination that puts you up to $45. That initial excitement, that initial success that you have, that psychological and neurological thing that happens to you when you win, makes you feel like you can win more. And then you keep doing it and you keep doing it. And then, since the success happened, you kind of prove to yourself psychologically that it will continue to happen until you realize that your money is gone and that you could have walked away with 45 bucks out of the 20 that you put in, but you continued. And that continuity and that overconfidence that you had made you lose everything you have. And that kind of happens also in finance too. Companies may expect that their interests have a priority. Investment agents have responsibilities to their clients, their employers, profession, and to the markets. To fulfill those responsibilities, brokers should always put the interests of clients, employers, professions, and markets before their own. Again, here's the word should, but in order to see action, you have to um, make it legal, make it legally binding. I think that's the only way that you can really ensure this should, if that makes any sense. And front running, insider trading, or market manipulation is something that should be avoided, and there's that word should again. Regulation of investment agents comes from market forces, professional associations, and self-regulating organizations, SROs, like FINRA, state and federal government oversight and enforcement agencies like the CFPB, Consumer Financial Protection Bureau, and the SEC, like the Securities Exchange Commission. Levels of government oversight are politically contentious and subject to change. Through consumer protection laws, investors have recourse for losses from unprofessional or illegal behavior. The best protection is to make good choices among financial advisors and investment brokers. Investing internationally, learning objectives. Identify the unusual risk of foreign investing compared to domestic investing. Discuss the use of the Economic Freedom Index, or the EFI. Explain the role of international investments in an investment strategy. Risks and regulation. Economies, you have developing, emerging, and frontier economies. You have 5 different risks: information, market, economic, currency, and political risks. Under information risks, you have accounting standards and reporting requirements. In market risk, you're dealing with liquidity. With economic risk, you're dealing with growth, interest rate stability, inflation, and unemployment. Again, unemployment has a very significant impact when it comes to like crime and other types of societal issues that take place. Currency, you have inflation and trade risks. And then through the political risks, you have stability, property rights, and regulation. So then this is an example of the uh, the world basically, and the level of economic freedom. So then here, for example, in the U.S., you have you have particularly good. Also in Canada, here we have Chile, Colombia, New Zealand. We have Japan, South Korea. What else do we have? We have Denmark, Sweden, Norway, right? The UK, Germany. Okay. So now we also have countries which are a little bit higher risk, and some of these include Ecuador and Venezuela. Mostly, I think, because of their political political issues. Um, you have Argentina and Bolivia also. You have countries in Africa. You have Kazakhstan, right? So then this kind of like gives you an idea. But um, even though, for example, we see that China's in the orange first, I mean, pretty much every time we look at any single product that we have, I'm sure that at home you have something that's made in China or everything made in China. So when it comes to producing, it's worthwhile to invest in China, in China's labor force, because then you can sell your products back home at a cheaper price, right? Um, so then there's a bunch of things to consider, and then also if you're looking into the Scandinavian countries, for example, yes, there's trade freedom, fiscal freedom, monetary freedom, and all that, but I don't think you're gonna find a lot of cheap labor here or a lot of cheap investments, right? I was actually looking at property values in Ecuador because I have family that lives in Ecuador versus Colombia. And then what I found was that you can buy in Medellin or in Bogota in Colombia a three-bedroom apartment, for example, or a three-bedroom condo in a really metropolitan area, very well centered, for about $300,000, right? So that's about $100,000 a bedroom. In Ecuador, you can get a five-bedroom house for about $100,000. So, that's another thing to consider too if you're trying to look into like investment properties, for instance. You want to be able to outweigh your risks and identify which are the risks that you are willing to take, right? And then in Venezuela, based on what we've seen in the news, you might not want to take that risk because we know, for example, that because of the government that they have in Venezuela, that the government has in the past come in and taken property and claim it government property. So that's something that you want to take into consideration. In Ecuador, I don't think that's happened, but in my last trip to Ecuador, one thing that I did notice, for example, is that in order to file your taxes, you also have to include how much money you spend in groceries because the president of Ecuador wants to track how much you're spending in groceries. So then here in the US, we're like, what the heck? That's not a good thing. Why would anyone want to regulate how much money we're spending in groceries? But actually that's something that they want to measure, perhaps for future regulatory purposes or rationing purposes, who knows. Key takeaways: the flow, quality, and comparability of information are concerns in international investing. Investing internationally may pose unusual risks compared to domestic investing, such as market or liquidity risk, economic risk, currency risk, political risk, and regulatory risk. And then when you're thinking of one of the things that I want to try to promote is more like global competency, for example. So whenever we see the word domestic, um, don't think of it as always being the US, for example, and internationally as everything else, right? Just think of domestically as where you live and internationally as other countries where you don't live. Because when you think of it like that, then it puts it into perspective and you realize that maybe another country, to them, they're also domestically in their own home country. So when they're looking at the United States, we're as all green, for example, they might say, For example, no, we're not, there's too much stuff going on in the US, so it's not worth the risk because of taxes, for example. Or no, there's too many regulations, too many licenses that I have to get, too many permits. I'm not going to invest in the US at all. But, you know, if you're someone who lives in another country, for example. So, domestic, where you live, internationally, countries where you don't live, and you know, just like how we perceive other countries and analyze these other countries can also look at us and analyze us in the same light as well. The Index of Economic Freedom measures a country's economic environment, growth potential, and regulatory costs, which affect investment risk. Greater investment risk require more research to gauge their effects on an investment opportunity and the overall investing environment. And this concludes the video for Chapter 14, the practice of investment. As always, if you have any questions, comments, or concerns, or want to elaborate a little more beyond the PowerPoint, beyond what's in the textbook, I'm always open for discussion. Thanks and have a great day.